Hello and welcome back to the Canadian Money Roadmap Podcast. I'm your host, Evan Neufeld. Today we are talking about how to keep your financial life in order when things go wrong by reducing single points of failure in your investment portfolio. Jordan, we're creeping up on the end of summer here. Did you have a good summer?
Sad time. Yes. Great summer. Yes. It's always sad though. You know, mid-August starts to creep in. The nights are a little cooler. Days are a little shorter. Well, that's okay.
But it's cozy, you know?
Yes, for sure. Get maybe a pumpkin spice latte going and something. And it's nice.
Yes. Depending on when you're listening to this, we might have the pumpkin spice present.
Mid-season already.
Oh my goodness gracious.
Something to look forward to.
Thank you so much for joining us today. If you're new to the podcast, please follow along with us, hit that follow button. And every couple of weeks, we'll send you an episode just like this where we help people invest smarter, reduce taxes, and create a retirement paycheck. But one of them is investing smarter, which is what we're going to talk about today. Let me backtrack a second here. Have you seen some of those crazy photos from this James Webb telescope?
I did. Those are impressive.
Pretty crazy.
Amazing.
I'm no astronomer. That's not not astrologer. I'm neither, actually. Yeah. But anyways, this thing is pretty cool. So for those of you who haven't listened, this isn't a science podcast, but James Webb Telescope is taking some pictures of galaxies and nebulas and all these things that I only have heard of before. I don't really know exactly what they are, but these images are pretty crazy. Anyways, lots of wild technology in there, but I was listening to a podcast that was describing how this thing got built. And they were saying that with this telescope, there's lots of moving parts, which is surprising to me for a telescope, but there's lots of moving parts with it. It has 344 single points of failure.
It's a lot.
Okay, let's unpack that. So a single point of failure means that if any one of these things fails, the whole thing is completely shot. It just doesn't work. That's mind-boggling how much engineering has to go into this. Jordan,
that's impressive.
You have an engineering background in a former life. Are you familiar with single points of failure?
Absolutely, yes. You want to avoid those as much as possible.
How many of those do you have on a bridge?
Yeah.
Probably zero.
Hopefully none.
Yeah, exactly. So 344, that kind of piqued an idea in my head and thought, well, okay, when in the investing world here, are there single points of failure that you can have in your portfolio? And I thought, yeah, there's lots. So today we're going to talk about some of those and some other ones that aren't necessarily related to investment portfolio either. Just ways that you can prevent yourself from getting into significant trouble. Before we dive into all the different options, maybe let's clarify failure here. Jordan, does failure mean like losing every dollar that you have?
Yeah, it could.
Yeah.
Like,
I hope not.
At the extreme extent. But no, failure I think could be more broad as, not reaching your goals at all or as quickly as maybe you might be able to, putting you in a situation where perhaps choices have led to, greater declines in your portfolio than could have been avoided otherwise by hopefully following some of these tips. So failure can be quite broad here, from the extreme of, complete loss, but even just much more moderate failure, or maybe just not quite maximizing the success that is possible.
Sure. So let's talk about some of those. The biggest one that jumped off the page for me is individual stock holdings. Nothing inherently wrong with them, but the issue with owning individual stocks is when you own very, very, very few of them. And the unfortunate reality is that companies go bankrupt all the time. Like, I'm not trying to scare anybody here, but it happens.
It happens.
It's not necessarily the TD Banks and Microsofts of the world, but big companies do fall from grace over time as well. So if you own an individual stock, let's use the crazy example of Enron. For those of you who are familiar with a big company, that there was a massive accounting fraud with it. It was a huge company. That was in, I think, 2001.
Yeah, it sounds about right.
When it happened. Many of the people that worked there, they received significant stock-based compensation. And so their retirements were almost comprised of entirely Enron stock. And when that company went bankrupt,
poof,
they got nothing.
Yeah.
Single point of failure. Now, that's obviously the extreme example. That's when in every, finance textbook around these days. But, more benign things like that could lead to significant declines in your portfolio. How do we avoid this one?
Diversified portfolio.
So you don't own just an individual stock. Even if it's a good company, things happen, right?
It's just putting all your eggs in literally one basket.
Right. So diversification is, as it was said, is the only free lunch in investing. It's boring, but boy, does it work.
It works.
Yeah. Okay. Let's keep going here. So owning one individual stock, that's a single point of failure. Another one could be owning just the stocks of one country.
Yeah. That's a good example. We were talking here, Japan, 1989. It hasn't recovered to those highs in over 30 years, or didn't recover to those highs in over 30 years.
Just very recently, I think it kind of got back to that high.
That's a long time.
Long time.
So if you only own Japan, and let's go worst case scenario in 1989, that's a long time to earn any sort of meaningful return from there. Now, again, that's maybe a bit of an extreme example, but I think the point remains that it's a potential single point of failure in your portfolio.
Yeah, and even large countries, like the United States, they've had long periods of time of negative or flat returns. Everything, depends on when you buy, and if you're consistently dollar cost averaging into the market, into a diversified portfolio, it limits these risks, of course. But one country can be a problem there too. Another thing along with the country side of things is investing in Canadian stocks or American stocks or European. It has nothing to do with the flag or a political leader or anything like that. It's just there's different sectors that are present in those countries that make those countries more or less attractive as an investment. Some of them have much better historical risk and return trade-offs than others. So you want to be careful with how you invest globally as well. But investing in any one specific country exclusively just opens yourself up to more risk than is necessary. So along with that, a lot of people here and in other countries fall, maybe not victim, but they end up having what's called a home bias in their portfolio.
Yeah, that's a good point. Home bias just being that, if we're here in Canada, we consume Canadian media, we see Canadian companies, we may be more inclined to invest in the public Canadian markets and companies there. Just something to be careful of, though. If you, let's say, just say live here in Canada, well, your job is tied to the Canadian economy. Value of some of your other assets, like your house, will be tied to the Canadian economy. And then if your portfolio is invested in solely Canadian companies as well, it's just another potential point of failure.
Sometimes things move in one direction all at the same time. That way,
your portfolio is dropping while your house price is dropping, while you're maybe losing your job. For
sure, we see that here in the prairies from time to time because our economy here, Alberta, maybe not Manitoba as much, but we have a lot of resource-based economy provincially, and so when resources do really well, people end up moving here to get those jobs that are paying higher, and so that bumps up the housing market. And so housing, think Edmonton, Calgary, Saskatoon, they move pretty well in tandem with resource prices, in both directions, right? So when oil and gas drops, housing doesn't look as fantastic there. So it's a bit of a compounding problem in the wrong way. Don't invest only in one country.
Yes.
Yes. Diversifying into more than one country just eliminates some of that risk of compounding the wrong way. Let's jump ahead into sectors. Only one sector. So during 2020, which is a completely wacky time to be investing, but tech was the only thing that made a lot of sense. Back in 2000, same thing, but everything only works until it doesn't. So, tech in the late 90s and early 2000s, there were some pretty scary declines that happened there. Perhaps it wasn't completely wise to be fully invested there, but when things go up, FOMO kicks in, and
you hear about your friends earning outsized, outrageous returns.
Yes. My neighbor said this. My friend said that. I heard on the radio this. Once you've heard about it, the money's probably already been made. And so really committing to any one sector can be problematic for one's portfolio. Any rules of thumb for sector concentration that you would recommend, Jordan?
Yeah, one might be, avoid maybe like 25%. Look at 25% as a max for one sector. So if you're going to invest in resources or commodities or something like that, make sure it's under 25%. Even tech, consumer discretion, any sort of sector that you can think of, try and keep it under that 25%.
Depending on where you're investing, it might be a little bit harder. So here in Canada, we just have so few meaningful sectors in publicly traded markets. So
Good thing we talked about more than one country.
yes, exactly. But even tech now, like the nature of investing in tech these days is way different than it was in 2000s, right? There's cloud computing wasn't a thing in 2000s, but neither were iPhones, right? All of these things are considered tech, but they're completely different parts of the market. And, 2000 was anything with .com in the name was $1 billion company. It's like, well, that's kind of stupid now in hindsight, but now there's really well diversified companies within there. So all that to say 20 to 25% in any one sector. Once you see your portfolio kind of trending in that direction, maybe rebalance into some other stuff. There's probably some deals to be had if your portfolio is trending in that direction anyways. Let's talk about speculation. This one's fun. We could have a whole podcast on this one, I'm sure. Every stock has a version of speculation baked into it, because when you buy a stock, you hope that it will increase over time. And so call that speculation. It's just hope. It's, there's a little bit of that baked into it all the time. However, there are certain types of investments, I will name them here, that I'm personally not as much of a fan of, crypto and commodities specifically. If anyone's a huge fan of those, feel free to send me an email. But these types of investments are based on the idea that the only way that it makes money is if someone buys it from you for more than you bought it for. They're not necessarily income producing assets in and of themselves. Let's contrast that with, say, real estate. If you have a rental property and you have someone living in there, they pay you rent every month, that's an income producing asset. If you own a company that pays dividends, that's an income producing asset.
I was going to say, go check out the dividend investing podcast.
Yeah, exactly. Whereas, I'm not as well versed in the crypto world. I know there's some other things in there, but let's just simplify it here. You own some Bitcoin. The only way it makes money is if someone buys it from you for more than you paid for it. Same thing with gold or silver. The only way that it makes money is if someone buys it for more than you. It's called the greater fool theory, that there's someone else that's going to be dumber than you eventually and end up holding the bag on it. Boy, maybe you can have some of that in your portfolio. I try to limit that as much as possible. But, the more you have in there, the more you're dealing with a faith-based asset, which I'd rather have income, profit-based assets. I don't want to spend too much time on there, but speculation. This one is a little bit more nuanced. And Trent, do you want to talk about how having enough upside in your portfolio or not having enough upside in your portfolio might be a point of failure?
Yeah, and I guess this probably comes back to understanding your asset allocation and what you're invested in. So not having enough upside potential would just mean you're invested too conservative based on your timeline to meet your goals, whatever those goals are. If you have a long enough runway, being too conservative is just going to lead to a portfolio that doesn't grow or have the opportunity to grow into what you want it to be, need it to be, whatever. This one is nuanced because there's, we can probably strongly say, like, don't own one stock in your entire portfolio. But we can't say everyone should have whatever amount of upside equities, stocks in their portfolio. And it's going to depend on each individual investor for what's appropriate. But I think what we could say is understand how you are invested and what your asset allocation is. So whether you have a pension plan or something or a group RSP or something where maybe you made a decision at one point, or maybe you just check something because you were filling out the onboarding paperwork or whatever it is. And maybe you don't even know, maybe you work with an advisor and you're just a little bit unsure of how you're invested. It's just worth knowing, I guess, how you are invested from an asset allocation, bonds versus stocks versus cash, to understand what is the potential of your portfolio to meet your goals and make sure that you are on track and have the opportunity to get there.
Right. A lot of the content that you'll see online maybe I hang out in a different part of the internet than our listeners, but you see a lot of DIY advice saying, just buy the S&P 500. Everybody should just do this and you'll make 12% a year. It's like, okay, investing is a little bit more nuanced than that. And not everybody has the risk tolerance capacity and risk attitude to just own something like the S&P 500 or the TSX or even like globally diversified equity only portfolio. Being a conservative investor is okay. Like, for sure, this isn't conservative shaming by any means.
Definitely.
It's just know thyself and know thy portfolio.
Yeah.
So if you want to be a conservative investor, do you know how much you need to be saving based on your expected rate of return to actually meet your goals? So being a conservative investor is okay as long as you understand what the upside potential of your portfolio is and you have the discipline and capacity to make it up with your savings rate. Right. So if your investments aren't going to grow by as much, you can just save more out of your pocket. That's fine, but you have to know that. And how can you know that?
Have strategies, have plans, and make sure you understand them.
Yeah, exactly. So we help people build financial plans. If you don't have one or even a good idea of one, feel free to reach out. Contact info is always in the show notes, or talk to your existing advisor. There's some calculators online. Even the government has one that you can kind of estimate how much you'll need to be saving based on about a standard rate of return. I recommend that people have a customized financial plan for them because planners like ourselves help people understand these things. I'll stop there, but making sure that you have enough upside to match your savings rate capacity. If you don't, that might be a single point of failure in your portfolio. Last one on the investing side here. Oftentimes when I've seen people that have pension plans, they have often invested in RSPs alongside there. Again, depending on your situation, that might be a smart move to do. However, when retirement comes around and you have guaranteed income sources, that means that you have a pretty set tax bracket that you're going to fall into for the rest of your life. So when you have a portfolio that's only RSPs, when you need to make money, what happens?
Everything coming out is taxed.
Everything. You have to pay tax on every dollar, and that stings. It's fine. That's the nature of the beast, and I hope that you knew that when you signed up for the RSP, but the portfolio starts to dwindle a little bit faster than you might have thought because of the additional tax that you might have to pay with that. So including a TFSA as part of your retirement income strategy is a nice way to limit some taxable implications of different types of spending throughout retirement. It just creates flexibility. Paying taxes isn't bad or anything like that, but by planning ahead, you might be able to avoid some additional taxes that you wouldn't necessarily have had to pay, especially for people that have a defined benefit pension plan.
This probably isn't the single point of failure, blow up your entire portfolio type failure, but it's not the optimized, most optimal way of structuring things.
Not optimal, paying more tax than you maybe should. Again, no, not a single point of failure. You're not going to blow yourself up by having too much.
Yeah.
Too much invested. Okay, what are some other things in your financial life that might be single points of failure? I think about insurance.
Insurance is important.
Or lack thereof, I should say. Yeah.
We insure our house, if our house floods or worst case burns down, we don't want to be on the hook for, hundreds of thousands of dollars there that we're left still owing on the mortgage. You can think about your financial life as well. So disability insurance, protecting your income should you become disabled. Life insurance, worst case, protecting your loved ones so they can cover off some debt and replace some income. On the flip side, too much insurance can be expensive and it's a bit of an art to figure out what you should be insured for. But definitely not having any insurance is one of those things that should the unfortunate event happen, there's a huge opportunity or huge risk, I guess. That
opportunity for risk.
Opportunity for risk. Yes, absolutely. No, there's just a huge risk there for you and your family and those that are left behind.
Let's hopefully add some reassurance here for many people who have benefits through work. Lots of you will have disability insurance already. Take a look through your benefits package to make sure you understand how that works.
Yeah, that comes back to what we were talking about earlier is know thyself, know thy work plan and know thy work benefits.
That's right.
Again, you might have got that when you started and you breezed through the booklet and it's now been 5 years. It's a good thing to make sure that you have everyone's plan is going to be different. So there's no one size fits all or anything like that.
LTD is the acronym that you might be looking for there. That stands for long-term disability. If you have questions about that, talk to your HR person at work.
There might be some life insurance in there as well.
Yeah.
Often it's not a whole lot, maybe 1 time salary or 2 times or something like that. But again, something to look into.
Some of these things like life insurance in particular, you want to be careful about relying too much on your workplace plan because it's almost never more than 2 times your salary and your mortgage is likely more than that alone, let alone replacing your income for a while.
And you might switch jobs.
Bingo, there we go. Yeah. So if you ever leave your job, you don't own that insurance policy. In some cases, you could buy it out, but in that case, it's probably more expensive than what you could have bought on your own anyways. So
just consider insurance as part of your larger financial picture and understand that there is a single point of risk there.
yeah. And so for self-employed people, disability insurance is something that you want to look at. For life insurance, there are very, very affordable ways to insure yourself through things like term insurance. It doesn't have to be expensive at all. Anyways, just make sure that that's covered off there. Now, on the spending side of things, there's a variety of ways that you could have single points of failure. One thing that I've seen pop up all the time here, and anyone listening is probably familiar with this, is that there's a subscription for everything.
It's definitely the business model of the decade over the last few years.
A lot of ways it can be great.
For sure.
But if you buy anything online, there's a variety of companies now that'll say, buy this with 4 payments instead of all at once. Like, oh, okay, that's not a subscription, but it's stretching everything out monthly. By doing things like that, you can really get comfortable with overspending beyond your income. And if you have things on a subscription basis, which I would almost include leasing a car, is almost like a car subscription in a way. You never really own anything, but yet you're always having to pay for it, right? So when you own something, say, okay, I've heard of some companies doing furniture subscriptions. Kind of a cool idea, but even after you've paid for something, you have to keep accounting for it in your monthly budget. That really starts to become troublesome. And then eventually, if you don't pay for these things anymore, the car disappears, the couch disappears. Like, now what? Be careful with subscriptions, especially when it comes to physical goods. This isn't like magazines and gym memberships, but just be careful of what you're stretching out from payments. Along with that, buying more house than you can really afford.
It'll be interesting to see how this takes shape now with rates now that they've risen fairly substantially given the most, our recent frame of mind. But, when rates were so low, it's pretty easy to extend your mortgage a little bit, maybe extend how much house you're buying, getting into something that you can't really afford. Maybe we're seeing it now as your rate perhaps has gone up, if it's variable or you're thinking about your renewal time, buying more house than you can really afford can put you in a bit of a pinch for sure.
My problem with house affordability is that there's been this stress test that's been put on people when they apply for a mortgage. And it says, okay, well, at this income and your other debt obligations, you going up to a much higher interest rate than is current, it appears that you could still keep making your payments. What that doesn't account for is your spending habits, right? So even if you don't have any other debt, but you're spending every dollar anyways, if your mortgage then increases, say you're on a variable mortgage and your payment goes up, because you're spending every other marginal dollar, no, you can't afford it anymore. There's no slack
in
anymore.
Your budget.
Yeah. So buying more house than you can really afford, know thyself and know thy budget, right? If you have to sacrifice your kids' diapers and putting food on the table, like, my goodness, no, you can't afford it. But then start taking a look at that budget and maybe scale back some eating out, going on the lavish vacations or things like that. Anyways, buying a house is a quick way to go broke. And that's very common for Canadians, being house rich and asset poor. Just be careful. Sometimes it's tough to avoid, but just be careful.
Okay, so what do we do about this? There's lots of single points of failure here. Are there any ways, or what are your recommendations for how do we avoid this as much as possible?
Well, when it comes to the portfolio, seemingly all of those problems can largely be solved or at least addressed by diversification. Diversification is your friend.
It's not a guarantee.
No, it's not a guarantee. No, it's not by any means, but it reduces certain types of risks within your portfolio. So globally diversified, even asset class diversified. So should you have 100% equities, maybe add 10% into fixed income, something like that. There's a lot of ways that you can add little bits of cushion in your portfolio. But again, you have to know yourself, what you're comfortable with, what you understand. And if you don't, talk to your advisor, do some research, things like that. Beyond that, insurance is your friend. Be careful about doubling down on things that you think might work. I've seen so much anecdotal evidence, when you own a little bit of, say, energy stocks recently, let's go all into energy. It's like, okay, well, now oil's now $80 a barrel or whatever it is. Everything works until it doesn't, right? Careful about doubling down. Think about it on the other side of things, right? Investing is inherently an optimist's exercise, right? You have to think positively about the future, or else you would never do it. You just sit on your cash. So it's very easy to just look at the upside only. flip every choice and decision on its head and evaluate whether your investment decisions are leading to single points of failure, right? So it's like, okay, well, this stock is looking really good. I'm going to buy some more of that, more and more and more. And it's like, oh my goodness, now it's 75% of your portfolio. What happens if this thing blows up? Well, you blow up along with it, right? Rebalancing is a really nice way to address some of these things that might happen outside of your control. So even if you just own a set portfolio, things that work will throw things askew over time. And so rebalancing is really important. That's why I recommend to do that on a fixed schedule. No one ever lost money by taking profits. That doesn't mean you have to do it every day, but don't be afraid to take some money off the table, buy something that looks foolish, because things, different sectors, different countries, ebb and flow over time. Rebalance, buy diversified portfolios, invest globally.
I love it.
Anything else? That seems to be it.
There you go. Try and avoid those single points of failure.
Awesome. Thanks so much for joining us today. If you haven't already followed along, thanks for all the ratings. We've got lots of ratings. It helps other people find the podcast. If you rate and leave a comment on Apple Podcast, that's great. We really appreciate all of those. Follow along and you'll see us in a couple of weeks. Thanks for listening to this episode of the Canadian Money Roadmap Podcast. Any rates of return or investments discussed are historical or hypothetical and are intended to be used for educational purposes only. You should always consult with your financial, legal, and tax advisors before making changes to your financial plan. Evan Neufeld is a certified financial planner and registered investment fund advisor. Mutual funds and ETFs are provided by Sterling Mutuals, Inc.